Brazil burned more than $11 billion to host the 2014 World Cup. 3 of the stadiums are abandoned. 1 is mostly a parking lot. The country went into recession the next year, and the people who decided to host it are still in office. This is not an accident. It is how the system is designed. The official infrastructure cost was approximately $11.6 billion paid for through federal funds, state borrowing, and private partnerships. The Brazilian Tourism Ministry projected a return of $13 billion in economic activity over the following decade. Post-event academic analysis found the actual return was a fraction of that, most of it concentrated in the 12 weeks around the tournament itself. The 4,300-seat Arena de Amazônia in Manaus, built in the middle of the Amazon rainforest for approximately $300 million to host 4 group stage matches, has since hosted local team games, drawing fewer than 1,000 fans on average. This is not a Brazil story. It is the story of nearly every World Cup since 1990, every Summer Olympics, every Super Bowl, and every major event whose economic impact study is published before the event and whose actual impact is measured after. The pattern is consistent. The story everyone tells before the bid wins is not the story the books tell 3 years later. Why? The fundamental economic structure of a World Cup is that FIFA owns the event, sells the global rights to that event, and collects the revenue from those rights, while the host country pays the cost of physically hosting it. These are separate transactions. FIFA does not pay rent on the stadiums it uses. It does not pay for the security, the transportation infrastructure, the immigration processing, or the medical preparations. Those costs are borne by the host country through some combination of federal taxation, state borrowing, and public-private partnership debt. In the official 2026 bid documents, the host federations committed to billions in combined infrastructure spending, stadium upgrades, security, transport modifications, and event-specific construction. Because all 16 host venues are existing stadiums, the 2026 tournament has significantly lower direct construction costs than recent precedents. Russia 2018 spent approximately $14 billion. Qatar 2022 spent a reported $220 billion, a figure that includes broad national infrastructure not directly tied to the tournament. The host country pays. FIFA receives the revenue from broadcast rights, sponsorship, ticketing, and licensing, which the prior episode on this channel walked through in detail. The economic question is therefore not whether the World Cup generates revenue. It does. The question is, who captures that revenue? And the answer, structurally, is FIFA and its commercial partners, not the host. The host captures whatever spillover happens during the event itself. Every host country, before bidding, commissions an economic impact study. These studies are typically conducted by consulting firms hired by the host federation or by the bid committee itself. They project gains based on tourism, infrastructure investment, increased global visibility, and induced economic activity. For the 2026 tournament, the impact studies commissioned by the host federations projected substantial tourism revenue, billions in induced economic activity, and a long-term tourism boost in the single-digit percentage range. These numbers will be revisited after the event. Academic economists have studied the historical accuracy of pre-event impact studies. The consensus across multiple meta-analyses, Bade, Matheson, Zimbalist, and others, is that pre-event projections overstate actual measured impact by a factor of 2 to 4 times. The reasons are consistent. First, substitution effects. Tourism spending during a World Cup substantially displaces tourism that would have occurred anyway, meaning a significant portion of the projected revenue is not net new but redirected. Second, crowding out effects. Host cities deter non-soccer tourists who would normally visit during the event, partially offsetting the soccer-driven tourism. Third, leakage. A substantial portion of the spending during a World Cup goes to international hospitality chains, multinational beverage and merchandise companies, and FIFA-licensed operators, meaning the money flows out of the host city rather than staying in the local economy. Fourth, opportunity cost. Capital invested in stadium construction, even at the modest 2026 levels, is capital not invested in housing, transit, or schools. The post-event reality consistently shows the projections were optimistic. The pre-event study is a marketing document. The post-event study is an accounting document. They almost never agree. A World Cup-grade stadium is a structure built to a specific physical specification. Minimum 40,000 seats, specific roof requirements, specific surface requirements, specific media facility requirements. These specifications are set by FIFA in its bid technical document. The structure is designed to host a maximum of 7 matches over the course of the 4-week tournament. The annualized cost of operating, maintaining, and amortizing the construction of such a stadium over its useful life, typically 30 to 50 years, requires hosting approximately 25 to 35 sold-out events per year to break even on a cash basis, and substantially more to generate positive returns. The economic problem is that most host cities do not have a professional sports market large enough to fill a 40,000-seat stadium 25 times per year after the tournament ends. The result is the white elephant problem. Stadiums that are operationally expensive to maintain, but rarely used. The Amazon Stadium in Brazil is one example. Cape Town Stadium, built for the 2010 World Cup at a cost of $600 million, is another. It has consistently operated at a loss, and the city has periodically considered demolishing it. The St. Petersburg Stadium, built for Russia 2018, the Lusail Stadium in Qatar, built for 2022, and the Cuiabá and Natal stadiums in Brazil for 2014, each of these is a documented case study of construction cost not justified by post-event usage. The 2026 tournament is structurally different because all 16 host venues are existing stadiums that predate the World Cup bid. Levi's Stadium in Santa Clara, MetLife in New Jersey, Mercedes-Benz Stadium in Atlanta, the Azteca in Mexico City. These are existing NFL or Liga MX venues with their own annual event calendars. The white elephant risk in 2026 is therefore largely confined to the infrastructure built around the stadiums, temporary facilities, expanded transportation, hospitality build-outs, rather than the stadiums themselves. This is the structural advantage of co-hosting in already developed economies. It is also why FIFA has shifted toward established markets for hosting going forward. The most consistently overstated category in pre-event impact studies is tourism. The argument runs, hosting the World Cup puts a country on a global stage seen by an estimated 5 billion viewers, and a fraction of those viewers will subsequently visit the host country, generating sustained tourism revenue for years to come. This is the showcase effect argument, and academic data does not robustly support it. Studies of post-2010 South Africa, post-2014 Brazil, and post-2018 Russia have all found minimal sustained tourism increases attributable to the World Cup. Tourism patterns reverted to baseline within 12 to 24 months, with seasonal variation indistinguishable from pre-tournament levels. The reasons are mundane. Most viewers watch the matches, recognize that the host country exists, and proceed not to substantially alter their travel plans. Travel decisions are dominated by direct flight access, language barriers, perceived safety, and cost of travel, none of which a World Cup substantially changes. Even in the immediate event window, tourism is not as large as projected, because the displacement effect, non-soccer tourists choosing not to visit during the World Cup, partially offsets the influx. South Africa's 2010 tournament was projected to attract roughly 450,000 international visitors. The actual number, after subtracting business travelers who would have come anyway, was substantially lower. The 2026 tournament has an asymmetric tourism profile. The US portion may see less proportional benefit because the US is already a heavily visited destination, and the World Cup represents a smaller marginal increase. The Mexico and Canada portions may see a more meaningful relative bump, but the long-term sustained tourism increase across all three host countries is unlikely to match the projections in the bid book. It rarely does. It would be inaccurate to say every host loses money. Several have produced results that read more favorably than Brazil's, though the academic record is more nuanced than the post-event public relations. Germany 2006 is the most commonly cited success case. The German Organizing Committee and government claimed multi-billion-dollar boosts to GDP and tourism, and the tournament is widely remembered as a national soft power triumph. But rigorous post-event analysis by sports economists, most notably Wolfgang Meinig's published work, found that the actual net economic impact was statistically negligible once you control for substitution effects, displacement, and the counterfactual of what the tourist economy would have generated without the tournament. Germany did not need to build stadiums. It hosted in existing Bundesliga venues, which kept construction costs near zero. That is the real reason the books look better than Brazil's, not a tourism windfall, but the absence of a stadium bill. France 1998 produced similar results: intangible feel-good effects, modest measured economic uplift, and a confounding variable in that the home team won the tournament. South Korea-Japan 2002 had mixed outcomes. South Korea generated infrastructure improvements that benefited Seoul long-term, while Japan absorbed substantial losses on stadiums that subsequently underperformed. The pattern across cases that look positive in retrospect is consistent: existing infrastructure, modest bid spending, strong domestic football market, and PR framing that overstates measured economic gains. The 2026 tournament checks several of these boxes: existing stadiums, established host country sports markets, modest direct bid spending. The structural argument for 2026 generating a positive-looking ledger is stronger than for several recent tournaments. The structural argument is not the same as the empirical result. That will be measurable in 2028. If hosting frequently produces negative economic returns, why do countries keep bidding for the right to do it? The answer is that the decision to host is not, in most cases, an economic decision. It is a political one. Hosting a World Cup, an Olympics, or any major global event generates a category of value that does not appear in standard accounting: national prestige, soft power, the legitimization of a political regime, and the consolidation of state-driven infrastructure projects that face local opposition under normal political conditions. Qatar's $220 billion infrastructure spending around its 2022 tournament was not primarily a sports investment. It was a national modernization program executed under the political cover of a World Cup. Russia 2018 served a similar function. The Soviet-era stadiums in St. Petersburg and Volgograd were renovated using federal funds that could not have been politically approved without the World Cup justification. The political logic of hosting is that the costs are borne by future budgets, while the political benefits, flag-waving, ribbon cuttings, presidential photo opportunities, accrue immediately to the politicians making the bidding decision. This is a textbook example of what economists call a time-inconsistent decision. The decision-maker captures the benefits in their term, while the costs are deferred to future administrations. The 2026 bid involves 3 established democracies with substantial budget oversight, so the time-inconsistent dynamics are less severe than in non-democratic precedents. But even in democratic contexts, the political incentive to bid is consistently larger than the economic incentive, and the historical record reflects that consistently. The economic structure of a World Cup is asymmetric by design. FIFA's revenue arrives largely before the tournament. Broadcast contracts are signed years in advance. Sponsorship money is paid up front. Ticketing revenue is recognized in the year of the event. The host country's costs continue for decades. Debt service on stadium construction, ongoing operational losses on underused facilities, and the opportunity cost of capital that was not invested in housing, transit, or education. The tournament happens. The lights come on. Several billion people watch matches over 4 weeks. Then the lights go off, and the visiting fans go home, and the books close. The host country settles into the long process of figuring out what its World Cup actually cost. For some hosts, Germany, France, the answer turns out to be reasonable. For others, Brazil, Qatar, South Africa, the answer takes a decade to fully reveal itself and is not flattering. The 2026 tournament has structural advantages over recent precedents. The hosts are using existing stadiums. The host countries are established economies with diversified tax bases. The construction commitments are modest. The historical pattern of overstated projections and understated costs is real. But the gap between projection and reality may be narrower in 2026 than in any tournament since 2006. The pattern will become measurable in 2028 and 2029, when the academic studies are published and the books are finally closed. Until then, what is on offer is the projection, not the reality. The story everyone is telling now is not the story the books will tell 3 years from now. They never are. Subscribe for more of the economics behind the institutions and events that shape everyday life.